So as we look at this market volatility, Si Katara is with us, founder, CEO, Tap Alpha. Thank you for being here. What did you think of yesterday? Knee-jerk, too much, just right?
Great to be with you. Yeah, it's interesting thinking about volatility and what's driving it. Yesterday's sort of news was a big unplanned event. And when it comes to, I think what the biggest Achilles heel is with respect to all of this investment in infrastructure for AI, it's the question of can we do it more cost effectively? And yesterday's white paper and announcement from DeepSeek was basically the answer that says, yes, we can at a fraction of the cost. So all of the investment plans, all of the earnings calls, for example, we're going to see this week, everyone's talking about hyperscaler investment into AI infrastructure. And yesterday's announcement was one of the things that basically said maybe all that level of investment might not necessarily be necessary in order to compete at the same level. And that's what caused the biggest sell-off in corporate history, which is $589 billion for NVIDIA, which was remarkable.
Right, that was their biggest day ever as far as selling. People are buying it back. Some people thought it was a great opportunity. I mean, even our prior guest said he bought NVIDIA yesterday. He bought Palantir yesterday. You saw a lot of those energy names dropping over 20% in one day. I mean, it was a tough day for folks. I definitely do not want to minimize it because while some didn't feel it at all, it really depended where you were in the market. Is this the kind of thing when we talk about volatility going forward? Be prepared. What do you tell folks?
Absolutely be prepared. Volatility is driven, events drive volatility in some cases. Two categories, unplanned, which was yesterday, and then planned, this is actually a great example for a week where volatility will likely be up. You've got 4 of the Mag 7 announcing earnings this week. You've got FOMC, the Fed decision on Wednesday, and then you've got an inflation gauge on Friday. These are all on the calendar, but they're all events that actually drive volatility. So the thing I tell people is, volatility in some cases is a scary word for a lot of retail investors. But in some cases, volatility can actually be something that benefits a portfolio if you have the right tools to leverage it. And that's where options come in. And the funds that we manage are very focused on leveraging options in order to help harness the volatility and the upside that you can actually harvest from that. And so be prepared, absolutely, and you can use these tools in multiple ways. But volatility is rising. It's been a rocky start this year. So for 2025, my advice is be prepared and use the tools that are available out there to harness the upside of what volatility can provide.
So how do you capitalize on all of this? I mean, you have options-based strategies. How do you really capitalize this? How do you really do it?
Yeah, there's, when volatility's up, option premiums go up. And so the question is, do you want to be on the buy side or the sell side when something gets more expensive? Well, we want to be on the sell side because the premiums are bigger, which means more potential benefit if you use it the right way. So one of the strategies we employ in T-SPY, which is our publicly traded ETF, is we sell calls on the S&P 500. And as that volatility rises, the premiums that are available to go out and collect for our investors gets bigger too. So one simple strategy that people can use is options applied as a covered call because premiums are larger, but you've got to do it in a risk appropriate way. So that's one way to harness the tailwind of what volatility can provide.
All right, so at this point now, we have a lot of other factors coming in this week, right? We're going to have a lot of tech earnings. Do want to get to the Fed, but your thoughts on the tech earnings, what you're watching for that is going to be key on how you might make investment decisions?
One of the things that we actually really try to avoid is what I call overnight risk. So we're long the S&P 500, and that's going to take upside and downside. But the volatility that's generated on short-term bases, and earnings happen after market. A lot of the macroeconomic announcements happen before market. And so one of the things that we're actually leveraging is what are called zero DTE, so 0-day options, which are just traded for the 6.5-hour session for that day. So in that way, you don't have to guess what those announcements will be one way or another. You can just leverage the volatility that's built into those premiums by just leveraging the same day option. And then when market closes, those, the earnings announcements happen, and you're already de-risked on the option side, and you're catching it with your long side. So that's how we end up playing really big announcement weeks. We avoid, trying to guess, and we just capitalize on that variability or volatility using those zero-day options.
Yeah, really interesting. So you could still play the volatility, but this may be different because the Federal Open Market Committee will get that announcement during the day, right? It's not before market,
Right.
It's not after market. That comes out at 2 p.m. tomorrow. We have a special show here on Schwab Network. What are you going to do for something like that? I mean, I know you like the S&P for the long term, but how do you play something like that tomorrow? Because, look, nobody's expecting a cut, but Jay Powell could say something that could really move the market.
Absolutely. So there's two ways we play it. One is because the volatility has increased significantly on that day, the option premiums that you see in the market, and just watch those options change, you'll see really large premiums that would otherwise be significantly smaller. So we end up leveraging that, and we move our out of the money positions way out, 1.5%, maybe 2% out of the money. So we're still taking advantage of some of that volatility, but we're trading that in for a safety buffer. And so that's how we do it for a low to a moderate risk profile. Other folks that want to make the guess and the bet can leverage those big premiums and actually put their strike prices much closer to what the market is. And they're making a bet maybe that Jay Powell will signal, less interest rate cuts. They're betting the market goes down. So they're collecting those big premiums by actually placing a position closer to the money. So those are two ways you can play at low risk. Or if you like the risk and you want to take advantage of it, you play it closer to the money.
All right. Pretty amazing. Any final thoughts here quickly, Si?
I'd say this is, it's kind of a perfect environment right now this year. We saw what happened in 24. I mean, incredible returns. People are, nobody can predict the market, but some folks are saying
Okay.
market's going to be up and down, maybe 8% plus for the year, but ultimately it's going to be a rocky road. Options tools are a great way for us to
Yeah.
take advantage of that rocky road and buy some cushions to sort of take advantage of what happens over the next year. So it's going to be a fun one. Hold on to your hats and use the right tools.
Yeah, and you brought to us TSPY. Folks can take a look at that from Tap Alpha. Thank you so much, Si Katara, founder, CEO, Tap Alpha. Good to see you today. Thank you.